Okay, this is a continuation of Accounting 113 for entrepreneurs. And we're wrapping up the chapter on tax, and then that's the end of the course. And of course, the last exam you'll have is going to be, I believe, let me see, it's going to be all on tax and payroll taxes. Anyway, we left off with we've done 23 and I think 25, and now we're on 26. And 26 deals again with a common topic again. What happens when you sell stocks and bonds? When you're an individual or when you're a business? It's not identical, but it's very similar. And in this case, here's the rules. Again, you can have long-term capital gain. You can have long-term capital loss. You can have short-term capital gain, and you can have short-term capital loss. If it's short-term, that means that you held it less than 1 year. Right? And if it's long-term, you held it for greater than 1 year. And the rules are this. Whenever any individual has a long-term capital gains and short-term capital gains, your first step is one, you combine like items. After you combine like items, then you offset like items. But when I say like items, when you offset, you're going to offset gains minus losses. Combine like items. You see that a like item would be anything that's a long-term capital gain will be another long-term capital gain. But then when we say offset like items, we're going to take long-term capital gains and long-term capital losses. And maybe I should say offset like, how about gains and losses? Offset like gains and losses. Let's just take the items out. And again, then 3. What is 3? We'll just say apply tax rules. Anyway, let's try this. Anyway, this is a person, this says during the year, Tamara, I'll use orange here. Tamara had capital transactions resulting in gains and losses. She sold stock in ABC Company, acquired 2 years ago. This is long-term capital loss, you see. Sold some collectible coins, held for more than a year. Collectible coins really are capital assets, but they're a specific category. They're actually called long-term capital gains and losses on collectibles. You don't have to know more than that. But anyway, let me see here. Held for more than a year. This is long-term capital gain. Stock sold in XYZ Company acquired 6 months ago. This is short-term capital loss. You see, it's a loss. This one's a loss, and this one's a loss. And then stock held in LMN Company acquired 3 years ago. This is short-term capital gain. All right, again, what we're going to do is, now that we've got them labeled, and by the way, why do we do this? Congress has said, if you'll separate these, we'll give you a better tax rate. In other words, you might say, well, why don't I just throw these into my tax return and they're taxed? You have to keep them separate. If you're willing to keep them separate, you'll pay a lower tax. And we have to take them and combine them all and reduce them and synthesize them down to their lowest amounts to find out what the tax consequences are. In this case, let's try and combine. We've got a long-term capital loss, a long-term capital gain, short-term capital loss, and a short-term capital gain. We've got nothing to combine. You see, each one of them is unique. So, combine like items, we can't combine. In other words, had we had another long-term capital gain, we would have added it to the long-term capital gain. If we had another short-term capital gain, we'd find it. But you see, everything's different. We've got long-term loss, long-term gain, short-term loss, and short-term gain. So, combine like items, it's done. Offset gains and losses that are like items. Well, that means, again, I'm going to take the long-term capital loss and offset it to the long-term capital gain. And in this case, what I'm going to get, let's see. Sold stock and acquired. Oh, this is long-term capital gain. I'm sorry. This is long-term capital gain. Anyway, we can combine. Yeah, this is acquired 3 years ago. That's long-term. This is short-term. More than a year ago, that's long-term. 2 years, yeah. So let's combine. Step one isn't done. Long-term capital gain and long-term capital gain. There's two of them here. So we've got $2,500 of long-term capital gain. We've got to combine. Now that leaves us, that's the only combination we can do. We also have long-term capital loss, and that's $1,500. And then we have short-term capital loss, and the short-term capital loss is $4,100. Well, again, now we've got the first step done. We combine the like items, which were the two long-term capital gains. Whoops, those are the two long-term capital gains. All right, 2,500. Now, what do? Let's take and offset like things. We've got long-term capital gain and long-term capital loss. By the way, I should have put brackets around these. The long-term capital gain, long-term capital loss, let's go ahead and show that as a loss, and that is a loss. All right, we're going to take the long-term capital loss and offset these. Do you see? Combine, offset like things. Long-term, long-term. This will give us $1,000, and that's going to be, do you see, a long-term capital gain. And then the last step is actually, we are going to apply the tax rules, but the last step is offset any long-term or short-term gains and losses. There is one more step. Offset long-term or short-term gains and losses. So we've got some short-term and we've got some long-term now. You see, these two have been combined to be 1,000 long-term. This is short-term capital loss. So I can take that and say, well, $4,100 of short-term capital loss will offset long-term capital gain. Now this is loss. So we'll end up with what? $3,100 of short-term capital loss. We are now done. We've offset as far as we can. What can we do with the short-term capital loss? Well, let's make sure. It says determine Tamara's net capital gain or loss as a result of these transactions. Well, that is the answer. She's got $3,100 of short-term capital loss. And that's what they would determine as net capital gain or loss. And that is it. This is the net. Do you see why they call it net? Because we net them out. We just keep combining them and then setting them off till we're down to, again, the sole remainder. The only way you can't offset them is if you get down to the end. Let's say there's short-term capital gain and there's long-term capital gain. You can't offset gain and gain. So you don't combine those anymore. But anyway, she is allowed to do this with it. She can deduct $3,000 of it for, that's so important, that's one of those really great deductions, for AGI. She's got a limit, that's the limit every year, $3,000. And the rest, the extra $100, she can carry over infinitely. You know, let's say carry over to future years. Now, why would she want to carry it to future years? Because she wants to use it as a deduction. Remember, these are negatives. They're going to save you taxes. So she wants to take that deduction to reduce her taxation. And she's going to carry that over. She's allowed to. The tax laws allow what's called carryover. She can carry that over to a future year. By the way, it keeps its identity. It carries over as, again, short-term capital loss. Anyway, that's the answer to 26. Now we'll go on to 27. All right, in 27, it's just asking us, would you compute the taxable income? The taxable income. Now, do you kind of remember the concept? You start in taxes with gross income. That's just anything. Some items in income are excluded. And then you actually take out, let me see, that, you know, after you take out your exclusions, you really just end up with gross income. But then you take out deductions for AGI, for adjusted gross income, and then you get adjusted gross income. And then there's more to it than that. But again, you got your gross income, you've got some deductions for adjusted gross income, and then you get adjusted gross income. And they're asking us, would you get taxable income? By the way, let's keep going on this, actually. After you get adjusted gross income, no. I'm just going to start anew. Just let me do the whole thing. Let's do it like this. You start with gross income. You put all your income, these are all taxable items. Now, if you have exclusions, you actually exclude them. You just leave them out. Don't put them in. Then you have deductions, and they're called deductions for adjusted gross income, and then you actually get adjusted gross income. So this is, again, these are money, these are deductions for adjusted gross income, then you get adjusted gross income. Then you take out the greater of your standard deduction, and it's the greater of your standard deduction or your itemized deductions. And in this case, there's other things too. There's tax credits, but this will give you, in general, taxable. Well, there's a little other thing. You can take out exemptions, and you can take out a new thing, a deduction. There's one more deduction. It's called small business income deduction. It's 20% of qualified small business income, but you're not going to hit that. We're going to stay simpler than that. But anyway, take out itemized deduction. The greater of these two. Remember, you get the greater, the standard deduction or itemized deductions, and then in general you get taxable income. And then you remember you have to go get the tax on that. So again, AGI, take out the greater of these two. I'm going to draw that differently. Let me put a big. Again, you get the greater of these two, and then that equals, finally you get down to taxable income. Okay. Now, let's take a look at this. This first one says, and again, it wants the taxable income for 2019. They're trying to say, would you go ahead and practice this little formula? All right, Drew and Meg, ages 40 and 41, respectively, they're married. Okay, that means they get what? Do you remember the standard deductions? They're $12,200 for a single male or female. They're $24,400 for married filing joint. And I think there were $18,650 for, again, head of household. So that was head of household. This was married filing joint, and this was single. I don't know if I'm right on that. I think it was $18,650. I don't have them all in my head, but it's close. Anyway, it says, respectively, they're married and filing a joint return. In addition, 4 dependent children. They have an AGI of 125 and itemized deductions of 27. Well, again, if we just go off to the side here and say, let's go ahead and say, again, they have $125,000. And you see, again, that's actually the AGI. They're starting this right here. They've already taken the gross income. They've got the deductions 4 out, so they're starting this right here. There's the AGI. They're just going to see if we know the difference between these two. Do we know standard? Do we know itemized? If they're married, they get a standard deduction of, we said, $24,400, or the greater of itemized, and they have itemized at 27. So again, the itemized deductions, do you remember what those were? Things like interest on your mortgage, your state income tax, your property taxes, medical expenses, unreimbursed medical expenses. That's what's in this 27. Anyway, you can see the 27's better, so let's take the 27. And again, if we take 27 out there, I think we're going to get $98,000. And that is the answer to, again, A. That is A right there. Okay. Let's do B. Sybil, age 40, is single and supports her dependent parents who live with her, as well as her grandfather who is in a nursing home. She has AGI of $80,000 and itemized deductions of $80,000. So she has $80,000 again. She has an $80,000 AGI. We're right here. So they've already taken the gross income and taken out deductions for. Do Do you remember what deductions for? The common ones are interest on student loans, capital losses. If you put money in a individual retirement account, that's one. Sometimes, there's some other ones that probably wouldn't have as much meaning to you, but those are the most common ones for AGI. Also, you can deduct alimony. That's another deduction for AGI is alimony. But anyway, they're single and they support, they're already down here again at AGI. They've done that. Okay, as well as her grandfather's a nurse, she says AGI of 80 and itemized deductions of 8. Well, she's age 40, she's single, but she supports her dependent parents who live with her. Do you know what this sounds like? This sounds like head of household, right? Do you remember head of household? What are the criteria for head of household? You got to have a house. You got to pay for over half the costs, the utilities, the bills, the mortgage for paying for the house. You have to have a dependent live there with you. It can be a dependent child or it can be a dependent relative. And in this case, that's what it is, parents, dependent relative, who live with her, as well as her grandfather, who is in a nursing home, as well as her, and she supports her parents who live with her, as well as her grandfather. She has an AGI of 80. She's head of household. So is she going to take the standard deduction of $18,650? Remember, there's the standard deduction. Or is she going to take $8,000, which is the greater? Well, you can see $18,650 is greater. So $18,650, let's take that out and see what she's going to have as gross income. That's going to be $61,350, I hope. Just doing the math in my head. But again, that's the answer to B. She's going to take the standard deduction. Okay. Let's do C. Scott, age 49, is a surviving spouse. Do you remember what a surviving spouse is? They also call surviving spouses qualifying widowers. Qualifying widowers or surviving spouses, they're the same thing, that's synonymous. Those are men and women who their spouses died, and they usually have a house, and they're supporting a child, and the child has to live in the house over half a year, and the child has to be a qualified child. I mean, it has to be a younger child. And that makes them a qualifying widower or surviving spouse. And what do they get for that? They get a great thing. They get, instead of being single, which is what they really are, their spouse is dead, they get to file married filing joint. Look at the huge deduction they'll get. So when he survives, his household includes 2 unmarried stepsons who qualify as dependents. He has an AGI of 75 and itemized deductions of 10-1. Scott, age 49, is a surviving spouse. His household includes 2 unmarried stepsons. Those do meet the criteria. A stepson or stepdaughter is a child who qualifies as dependents. He has AGI of 75 and itemized deductions of 10-1. All right, he has AGI of 75. Let's jump over here and do 75,000 is his AGI. And again, he's going to get 24,400. Now, he's got itemized deductions of 10-1, but do you see those are very crummy? 10,100. We're not going to take those itemized. We're going to take the standard deduction. And I believe that's going to be 50,600. Is that going to be? Yeah, I think so. 50,600 is the answer to C. All right? That was the answer to B. Yeah, that was the answer. Come over here. We draw an arrow there. That's the answer to C. All right. How about we do D. Amelia, age 33, is an abandoned spouse. All right. Now, an abandoned spouse is usually an abandoned spouse. If they really are an abandoned spouse, that means your husband or wife ran off on you and just left you. You realize that, again, you're not, well, you don't really want to file as married, filing jointly. You could. You actually, as an abandoned spouse, you could file married as filing jointly, but you probably won't be able to do it. And most people can't because that spouse has run off. You don't know what money they made. You don't know what deductions they have. And by the way, you're responsible for if you file a tax return and your spouse has made a bunch of money and not paid taxes on it, you're joint and severally liable. So you're liable for if your spouse's taxes. So you don't really want to be involved with a spouse who ran off with you. And don't file a joint return, because you might be in trouble. But anyway, Amelia, age 33, is an abandoned spouse. If she is an abandoned spouse, she will get, guess what? Head of household rates. Who maintains, now to be an abandoned spouse, again, you have to have a qualifying child. Not a qualifying relative, but a qualifying child live in your house. She's age 33, who maintains a household for her 3 dependent children. That sounds good. She has an AGI of 58 and itemized deductions at 1065. All right, she meets the criteria. She has a child. They live with her over half the year. She has a house. She maintains a household. She'll get head of household. So again, we'll go over here and say she has an AGI of 58,000. Pull out, what is that, 18,650. Remember, that's greater than, she does have itemized of 10,650. But do you see you get the greater? You get the greater of the standard deduction or your itemized. So she's not going to do that. And that's going to be 40, what is that, A, 50, 40. I think that's going to be 39,350. Since I'm on the fly, I hope this ain't equals. But anyway, that is the answer to D. That's the taxable income in that one. Taxable income A, taxable income for B, C, and D. Okay? And let's wrap this up with E is the last one. Let's do that one. Which one have we used? I haven't used orange. Let's do E. E says Dale, age 42, is divorced, but maintains a home in which he and his daughter, Jill, live. Jill is single and qualifies Dale's dependent. Dale has AGI of 64,000 and itemized deductions of 99. So again, we're down here with Dale, and he has $64,000. I realize he has $64,000 of AGI, and again, does he make it, now he doesn't really want to use single. That's the worst. You want to get into one of these two. He can't use married filing joint because he's divorced, but maybe you can use head of household. Again, to be head of household, he has to have a house, pay for the money over half the money for the house. He has to have a qualifying child as a dependent. And the child has to live in the house. The child has to be in the house. Can't be. So divorced, but maintains the home, that's good, which his daughter, Jill, lives. Jill is single and qualifies as his dependent. Dale has AGI of 64. He is going to get that head of household and itemized deductions. So he'll get the 18,650. Now, he does have itemized of 99, doesn't he? 9. But you can see 99 is less. You want a bigger standard deduction. So we'll take that 18 out. And 44, 46. I think that's going to be 45,350. You better check the answer manuals, make sure my math is right. But anyway, that's going to be taxable income for E. You know what? I might have jotted down the answers to these when I did them. I've done it before. Let's see. Which one is this? This is 27. 97.98. I got that one. And the next one is 61. That one's 61,650. I made a mistake there. Then the next one is 50,600. That's right. Then 39. That should be 650, shouldn't it be? I did that one wrong too. And then 45. Oh, I did that too. That should be. Those should all be 650. Whoops. Okay. 45, 650. This should be. It seems odd to me. Is that right? 18,000 from that. 650. It seems like it should be. All right, and this one, what was the other one I made the mistake on? This should be 98, 650. Yeah. You know what? There is an issue here. I think this might be 350. What is it for qualifying? Let me check that. Let me see. This is 27. All right, I was done with this, but I did discover a small error. I had my standard deduction for head of household 18,650, and that's not right. It's 18,350. But everything we did was right. I just went back and replaced, There needs no explanation. We did everything perfect, but again, the answers are slightly different. I should have 18, not 650, but 350. Here's the right answer. Here I should have had 18, 350. That would give us just a slightly different answer. This one, I think I discovered my mistake, but 64 minus 18, 350 is 45, 650. So anyway, all these are rights, and our methodology was totally right, but try to remember head of household is 18, 350, not 18, 650. All right, we'll go to the next problem. All right, next exercise we assigned is 28, and this is very similar. It says compute the taxable income for 2019 for Emily. Emily has quite a few things, but let's try to review that again. Generally, we start with gross income. And gross income means we've already excluded certain things. Like again, if you get life insurance, somebody dies in your family and they give you life insurance proceeds. Life insurance pays out. That's excluded. Remember, Congress doesn't tax death. Or they sometimes do tax death, but not in that case. But anyway, those things are excluded. And then again, you're going to take out deductions for AGI. And then you get AGI. And then basically after you get AGI, you take the standard deduction or the itemized, whichever is larger, remember, whichever is larger, these two. And there is another deduction you get to take, which is again that small business income, which is 20%, but we don't have it in this problem, I know that. So then we'll get to taxable income, all right? So again, that's our general model here. Let's go ahead and take a look at this. Again, we've got, is this going to be Emily? Emily has a salary of $85,000. She has interest income from bonds issued by Xerox. That's fully taxable, so that's still, this is gross income. Over here, we're trying to get to, this is gross income. Alimony payments received. The divorce occurred in 2014. If the divorce had occurred in 2018, I think, no, 2019. If the divorce occurs in 2019 or thereafter, Trump made new laws on that. And now after that, they are not taxable. But now this is taxable, so you're going to put those in there, $6,000. Okay? So alimony payments received, again, before the Trump changes are, these are taxable. Contribution to a traditional IRA. All right, by the way, this is gross income. Let's stop. Well, I can look at the rest. Gifts from parents. Oh, okay, let's keep going. Gifts from parents. What would you want to show? That's the age. The gifts from parents are 3 up. No, they're not taxable. That's excluded. Don't put it in. Just exclude it. We could put the 25 there, but we're excluding that. Gifts from your parents are not taxable. Short-term capital gain from a stock investment. That is. I shouldn't have drawn this line so soon. That is taxable. Short-term capital gain from a stock investment, that's taxable. $500 amount lost in a football office pool. That's a personal bet. It's not taxable. Now again, if you'd entered into stocks or bonds or land or real estate, things like that, and lost $500, you could probably deduct that. But that wasn't entered into for a profit, at least not by Congress's terms. I know you're saying, yes, it was, Chuck. They entered into that for profit, but that is, again, not a stock or a bond or land or real estate or oil or rental property. Those are all the things that you can usually deduct. This does not make, that's a personal little bet. It's a gambling loss. You can't deduct it unless, well, anyway, let's not get into that. All right, what's this? Short-term, what do we say here? I put that up there, 2,000. And then we got, this is a deduction. This is a minus. You see, these are all income, income, income. This is income that's excluded. This is income. And that's a loss, but we don't get to take it. So again, in fact, we'd say E here for exclusion, and this is ND, not deductible. It's actually a loss. These two are your losses. Well, let's get the gross income here. And the gross income is going to be 85, what is that going to be? 6, 7, 8, 9. That's going to be 94,000, I think, 100. That's going to be your gross income. Now let's take out any deductions for AGI. Do we have any? Yes. Contributions to an IRA. There's a limit to that. $6,000 a year, but you can deduct that. You're going to put that in a savings account for when you get old. So you can take that $6,000 out of there. That's deduction for AGI. That's where we're at right here, for AGI. And I believe we're going to get AGI is going to be 88,000. I get that right? 88,000. What do I got here? Did I miss anything? $500, 100. Oh, I did. I took out 6,000. I should have been 55. Sorry about that. That's the limit. The 6,000 is your limit every year. But you can take out, again, that's what she actually put into the account. So this should be 88,600. That's your AGI. Now remember, after you get your AGI, you take out your standard or your itemized. What do they got? I don't know if she's got any itemized, does she? Again, Emily doesn't say that she does. I don't know, is there more? There's not more to this, is there? No, this is it. So again, salary, interest, and alimony. Okay, so she's just going to get, now she is Emily. It sounds, her filing status is single. She's 40. She's going to get, you remember, for a single person, she'll get in 2018, actually in did they say 20? No, it's 2019. That's $12,200. That's her standard deduction. And that's going to be 400, let me see, 90, oh, whoops, that's not 90, $76,400. $76,400, that's your taxable income. And that is the answer. And that's what they want. The taxable income for 76,400. Then we'll go back to that and use the single rates and find out what our taxes due are. So that's number 28. And we'll go on to the next one. All right, this is another one that's very good. It's the same computation. It's just saying, this is number 29. Get the taxable income for 2019. Looks like Aiden is who we're working on. Aiden is married, but Aiden is married, but has not seen or heard from his wife since 2017. So Aiden has the choice again. Where Aiden cannot file. He could file as married, but he doesn't want to do that because if he files as married, he doesn't know what his wife's doing, and he would be then responsible for his wife's taxes. And so he doesn't really want to do that. He doesn't want to file as single because those are the worst rates. Remember, married, he gets $24,400 standard deduction. Single, he gets $12,200, but he'd rather get head of household, which would be, what did I say, $18,350. Remember in the last problem I said $650, which was wrong. So he's after this. Let's see if you remember what you have to have. You have to have a house, you have to pay for the house, and you have to have a qualifying child in it. And the child has to live in the house. And the child has to be a dependent. But again, Aiden, on the basis of the following, Aiden is married but has not seen or heard from his wife. This is called abandoned spouse. An abandoned spouse, when we talk about abandoned spouse, if you can prove you're an abandoned spouse, you get this rate. Okay, number of defendants. He's got children ages 17, 18, and a mother-in-law 70. The mother-in-law wouldn't do it. She's not a child, but these children will do it. So he's probably going to get head of household. Yeah, he's called an abandoned. He's got an abandoned spouse, so he is an abandoned spouse. Anyway, let's do this. Let's see again. Let's do it over here. We seem to have a little more room. Just in white space. Again, it looks like salary of $80,000. Let's again get the gross income. Remember, let's get gross income. $80,000. And let me see, interest on bonds issued by City of Boston. No, those are municipal bonds. It's excluded. Exclude that. Don't put it in your gross income. Because again, remember, the federal government doesn't tax income off of other governments. There's an agreement there. Do you see the logic in it? You don't want to, the federal government, if they tax that, then people might not want to buy those bonds. That makes them less attractive. So again, and this is again bonds, so that the federal government says, hey, we won't tax you as an intergovernmental respect to again make your bonds more attractive. And that way you can use the money that you get for the City of Boston. And there's a that's a good policy, I think. Anyway, so that's a cash dividend received on Chevron common stock. Well, that's taxable, $2,200. Life insurance proceeds paid on the death of an aunt, a very large sum. That's excluded. Congress doesn't tax death, usually. So again, if you get life insurance proceeds, not taxable. Inheritance received upon the death of an aunt. Now that's different. Life insurance is when a company pays off. Inheritance is when your aunt gives you $100,000. And guess what? Gifts are not taxable. Actually, if you took more tax, you'd learn that gifts are not taxable to the recipient, but gifts can be definitely taxable to the donor, to the giver. To the decedent, the deceased, anyway, they can be taxable upon the aunt. I know you're saying the aunt's dead. No, they'll go after the aunt. They can go after her estate. Jackson, a cousin, repaid a loan Abe made to him in 2013. No interest was provided. Well, repaying a loan is not income. Remember, he loaned somebody $5,000, and then the guy paid him back. Do you see that there's just equality there, parity? You're no better off. There's not a concept of income there. You loan money out, you got it back, you are the same as you were before. You have no incremental gain in there. Itemized deductions. He does have itemized deductions. Now let's take a look at what they are. State income tax, property taxes, interest on his mortgage, and charitable contributions. That's another one I forgot to mention, but if you give to your church or you give to the American Red Cross, all those are deductible. And he's got $9,700. That's not very good. You can see the standard deduction is going to beat it in every case. Number of dependents, he's got 3. All right, well, let's go ahead. We've got the gross income here. I guess that's it, right? We excluded this. We had the $80,000 on the salary, interest by the Wells Fargo Bank. Oh, we did miss that. $2,200 for cash dividend. It was the city of Boston. These two are both taxable, $2,000 and $2,200. So those are both taxable. And that's it. So now we'll have our gross income, which is $84,200. And that is GI, gross income. Now we have deductions for adjusted gross income, but there are none. You see there's nothing negative here. There's no deductions for AGI. So we can say our AGI there's 0 deductions for, so they're $84,200 is AGI. Now we get to take out the greater of itemized deductions. And the itemized deductions, they said, are right here. Here's itemized. And this guy's going to qualify, Abe's going to qualify for head of household. Well, you can see $18,350 is greater than $9,700. So we're going to take $18,350 and subtract that, and then we will get taxable income. Now remember, on most tax returns, whoops, I wish I would have written that all over there. And that's going to be, let me see, 18 from that is 65,850. And that is the answer to 29. 65,850 is the taxable income, and that's what we want. Aiden's going to have to go back and put that in what? He's going to get head of household rates. He's not going to have to use single rates. He's not going to use married filing joint. He'll get head of household, which are better tax rates. All right, let's pause and then move to the next problem. Okay, this is continuing number 30. Number 30 is just asking us to calculate the standard deduction allowed for 2019. Remember the standard deduction for a single person? They get $12,200. If you're married and filing joint, you get $24,400. If you're the head of household, you get $18,350. If you're married going single, you get $12,200. And actually, I forgot one. I didn't do, oh yeah, I did. I got them all. I got the head of household. But if you're a dependent, you get a lower standard deduction. Remember, dependents don't make a lot of money usually. And so Congress said we'll give you either $1,100 as a standard deduction, or the greater of that, or your earned income plus $350. But these things can never be greater than the single standard deduction. You see the logic in that? If you're a child, a dependent, well, you really shouldn't get more than an adult. So they're saying if you do this calculation, it should never exceed 12.2. Anyway, let's have a go at this. Curtis, age 18, has income as follows. By the way, it says, determine the amount of the standard deduction allowed for 2019 in the following independent situations. In each case, assume the taxpayer is claimed as another person's dependent. So this is a dependent. These are all dependents. Curtis, age 18, has income as follows, $700 interest. Do we care about interest? No, we don't, because that's passive income. That's not earned income. Earned income is when you sweat and labor and work. That's passive income, interest and dividends from a certificate deposit, and $12,400 from repairing cars. Well, $12,400 plus $350 is earned income is going to be $12,750, right? But remember, there's a limit. You can't. By the way, that's better. Do you see again? You could say, you know, what's better, 1,100 or this? Well, certainly this is better than 1,100, but there's a limit. You can never go over what the basic standard deduction. So again, in this case, it says what is the standard deduction going to be? It's going to be $12,200. Again, his earned income plus $350 is $12,750, but he can't have more than the average person. So there's a limit. All right, now it says Matty, that's a nice name, 18, has income as follows, 600 cash dividends. We don't care about that. That's passive income from a stock investment. And 4,700 from handling a paper route. Well, we do care about that. That's earned income. 47 plus 350. That's going to equal $5,050. $5,050 is certainly better than 1,100, so we don't want to take that. We'll take the 5,050. And I believe that's going to be the answer to this one. That's it. That's going to be her standard deduction. I guess Maddie, it sounds like that's a girl. $5,050. Okay. How about C? Jason, age 16, has income as follows: $675 interest. We don't care about that. That's again, passive. And $800 for painting a neighbor's fence. $800 plus $350. That's his earned income. That's going to be 8, 9, 10, 11. That's going to be $11,150, isn't it? Yeah. What's better, $1,150 versus $1,100? It looks to me like that's the answer, $1,150. So again, we don't want to take the $1,100. $1,150 is the answer. Let me see here. D. Ayla? I'm not so sure I've seen that name before. Ayla? Ayla? Ayla, age 15, has income as follows: $400 cash dividends, don't care about that, from a stock investment, and $500 from grooming her pets. That sounds hard. 500 plus 350, that only equals 850. And 850 versus, again, 1,100, the greater. You don't want to take the 850, you want to take that 1,100. So 1,100 is your standard deduction. Sarah, age 67 and a widow, has income as follows: $500 from a bank savings account, that's passive, and again, that's interest, and $3,200, she's a babysitter. Okay, let's do that, a babysitter. 3,200 plus 350 is going to be equal to, actually though, she's older, isn't she? She's 67. Do you guys remember, this is a special case, do you remember you can get an additional standard deduction? If you're 65, if you're equal to 65 or older, you can get an additional standard deduction of $1,650. If you're married, it's only $1,300. But if you're single, it's $1,650. So she gets the 32 from her earned income, the 350, but then she's also going to get 1,650. By the way, let's just do our comparison. 350, that's going to be 3,000, what do we say, 3,550, isn't it? Yeah. 3,550 versus, again, just, what's the standard 11? Well, we don't want that 11. That's too small. But then we do get to add to it. Let's take this and add to it her 1,650 she gets for being greater than 65. And that's going to be 4,000, that's going to be 5,000 something. Let me see, 0, 0. And then 5 and 5 is 0. You carry the 1. 6 and 5 is 11. That's 12. And 12 and 3 is 4. I think that's 5,200. Yes, that's right. So she'll get $5,200 as her standard deduction. 3550 and 650, that will give her 5,200. So that's all the standard deductions for, again, someone who's a dependent. All right, we'll go to 31. And again, this is a tough area. It's, again, who gets to be a qualifying child, who gets to be a qualifying relative. All right, we're moving on to 31. 31's something we've talked about quite a bit, but not really hit on it hard. But I've already talked about this, that in the tax laws, it's very important, many places in the tax laws, for you to get certain deductions and for you to be eligible for certain credits. First of all, the child tax credit, which is really a great one, but we'll talk about that later. But again, to get those, you have to have a qualifying child. Or, in some cases, you have to have a qualifying relative live with you. You have to support them. In other words, these are things that are in our tax laws. The Congress in this country has said if you have a child or relative that you're supporting, we'll give you more favorable tax laws and rates in general. Here's the criteria for a qualifying child. And I use this acronym, RAS. That stands for our relationship, residence, age, and support. But here's what to have a qualifying child, it has to be a child. Now, I've always felt like it's actually easier to name who's not a qualifying child. Who's not a qualifying child? Your mother and father are not a qualifying child. Your grandfather and grandmother are not qualifying children. No aunts and uncles are not children. In-laws are not children. Cousins are not children. And again, anyone older than you. You is the taxpayer. Are you with me? You're the taxpayer. So anyone older than the taxpayer can't be a child. But you see, again, it's easier for me to tell you these are not children. Your mother, father, grandmother, anyone older than you, in-laws, any in-laws, father-in-law, mother-in-law, brother-in-law, aunts, uncles, and cousins. This is the group that you can't put in here. Everybody else usually is. Then residence. You have to live in your parents' house over half the year. Now, you don't have to live in half the year if you're a college student. They make exceptions for college students or medical treatment, medical emergencies. Age, you have to be less than 19 or less than 24. 19 if you're just a young kid, but 24 if you're a college student. So that 19 applies to everybody. Unless you're a college student, you have to be less than 24. Support. The child can't be self-supporting. That means the child cannot provide over half of their own support. That's things like food, clothing, shelter, transportation, medical bills, again, all those things. So again, these are the 4 criteria to get a qualifying child. Now, if you don't have a qualifying child living with you, try and have a qualifying relative. Qualifying relative is everybody except cousins. I don't know why. Congress, I don't know why Congress does some of the things they do, but Congress drew a line and said, all right, anybody that's in your family can be in-laws, your aunts, uncles, mother, father, grandfather, mother, all of them, except cousins don't qualify in the relationship. So just about anybody. Gross income, you can't make over $4,200 if you're going to be a qualifying relative living with being supported. And you have to support let's say it's your brother or sister, you have to support them with over half the support. By the way, there's an extra rule. Let me see, what was I going to say? I can't remember. Qualifying relative? Well, anyway, we'll go on. In this one, it basically is asking us to, again, try and identify attributes of a qualifying child or qualifying relative. And it says, analyze each of these characteristics and consider the test for dependency as qualifying child or relative. So again, we're going to put it like this. Let me see, they're going to say yes, qualifies child. We're going to say that, we're going to do it this way. They want us to say met or not met. They say, tell us if the test is met, but we're going to say these mean, in other words, we're going to answer yes and no. Yes means you qualify and that you can get that deduction. So yes, if you can qualify for the child. Yes, if you qualify for the relative test. But no if you don't. In other words, if we find somebody that's over the age 19, we're going to write no. The issue here I want to go after is, do you, yes, qualify for getting that child as your dependent? Do you qualify for that relative? Let's run through these. And again, taxpayer's son has gross income of $7,000. Well, qualifying child test. In this one, they want us to go after child gross income. That's not going to be a problem. Well, these really are lengthy. Anyway, we'll do them all. Taxpayer's son has gross income of $7,000. Well, there is no gross income. That's okay. Yes, you can take that deduction. Again, taxpayer's son has gross income of $7,000. There is no test for qualifying child. Do you see? There's no gross. It's relationship, residence, age. So yes, that's not going to be a problem because we do qualify because there's no test for it. Now, under qualifying relative, if it's qualifying relative test, there is a test for gross income of $42. And guess what? That's no. You're not going to qualify anymore because you've got $7,000 and that breaks through the limit. Taxpayer's niece. All right, let's just real quickly, a niece. A niece is going to be a qualifying child, or a niece can actually be a qualifying relative too. Remember, if you qualify up here, you qualify down here too. Meaning for the relationship, just the relationship. Taxpayer's niece has gross income of $3,000. Well, again, for qualifying child, there is no gross income test. So, yes, there is nothing. The qualifying child income's not going to be an issue. So, yes, you're always going to qualify. Gross income, this one's going to be yes too, isn't it? Yeah, because the niece only has 3. That's below the limit. Taxpayer's uncle lives with him. Taxpayer's uncle, and uncle is not going to make it up here. So we've got to be careful on that. So under a qualifying child test, does an uncle make the relationship? No, it won't, right? Because an uncle is, we said no aunts or uncles, right? No uncles or aunts. But an uncle or aunt will make it down here as a qualifying relative. Relationship? Yes, it will. Yes, you're okay with an uncle there. Age and age. Taxpayer's daughter is 25 and disabled. As soon as you see that, I didn't write that up there, but how do you think Congress looks at a disabled child? Do you think Congress is going to stop you from getting a deduction for age? No, this is one of the exceptions that's in the tax laws. You can read the book, but you can sometimes just guess that Congress is not going to make people, go ahead and say, you don't get a deduction or you don't get a qualifying child because, again, they're 25. Well, a disabled child is many times, going to be living with you the rest of your life. So guess what? Yes and yes, no matter what. Taxpayer's daughter is age 18, has gross income of 8, and does not live with him. Uh-oh. Well, again, right away, they want to do 2 of them here on this. These 2 both line up with this one, don't they? All right, residence. Well, this one for a qualifying child, remember, they have to live in the house over half a year. So for a qualifying child, she does not live with him. This is going to be a no. How about gross income? There is no gross income test for child. So yes, that's okay. There's no gross income test up there. Now let's look at this one. Gross income over here, she makes $8,000. That's above the 42. So she's going to not qualify there. Let's go down here. Taxpayer's cousin. Well, cousins do not qualify as, again, a cousin does not qualify up here, and a cousin doesn't qualify down here. But it says taxpayer's cousin does not live with her. All right, well, the relationship on this one is no and no. Cousin is not, taxpayer's cousin does not live with her, no. And then residence, taxpayer's, this is relationship. Relationship is no, and residence, under this one, residence, this would be a no also. And that's it. That's all we have to do. So a cousin that does not live, it fails the relationship test. And no, you're not going to get a qualifying child because they don't live with there. They fail the residency test. And they also fail the relationship down here because you can't have a cousin. That's where Congress said they drew a line. Taxpayer's brother does not live with her. Okay, taxpayer's brother. Now, again, up here, taxpayer's brother. Taxpayer's brother, that's going to be, that will be the criteria here, and that will be the criteria here. But residence does not live. Okay, that's going to violate the qualifying child, so no. No, they have to have residence. Then there's another one here, relationship. Well, a brother is okay, so that's fine. A brother can be a qualifying child. The taxpayer's, I got on the wrong one. Taxpayer's brother doesn't, sorry, shouldn't be that one there. Taxpayer's, now what about this? Relationship. All right, relationship for qualifying, the tax brothers, that's okay for relationship, yes. In other words, for a qualifying relative, can a qualifying relative be a brother? Yes, that's fine for the relationship, and that doesn't violate anything. Relationship on this one, taxpayer's sister has dropped out of school, is age 17 and lives with him. Well, what about, this one has 2 of them here. Oh, this has 3. There's 3 of them. All 3 of these apply to this one. They want us to do all 3. All right, for qualifying child, this is for a sister who dropped out of school. Relationship, a sister is fine, yes. Sister is fine. Residence, she dropped out of school, but she lives with him, that's fine, she'll meet that test. Again, you see they gotta have the residence. She's a sister. Age, she's 17, 17 is less than 19, that's fine too, she'll qualify. All right, what about relationship under qualifying relative? Well, under qualifying relative, does a sister work? Yes, a sister will work just fine. Taxpayer's older nephew is 23 and a full-time student. Older nephew, nieces and nephews will make it under this one, and nieces and nephews will make it under qualifying relative, both. And this one, they want us to do 2 of them again. This one, they're blocking off, I think, these 2, and this one blocks off these 2. And this one, I think we had to do, was it up here that we did 2? Yeah. All right, taxpayer's older nephew. No, nephew will not work, because you remember we said anyone older than the taxpayer. So no, you can't have someone older than you that's your child. Taxpayer's older nephew is age 23 and a full-time student. Relationship, that's going to be no, because he's older. Age, 23 and a full-time student, he's okay. 23 and a full-time student, that's fine. Now you guys realize, if you get 1 no, you're out. What I mean is you have to meet all the criteria to be a qualifying child. So when you see a no, like in this one, it says no and yes. Do you still have a chance? No, you don't. You cannot be a qualifying child if you have any no's. Now how about could he be a qualifying relative? This says a relationship is a nephew, age 23. Well, in this case, a nephew is fine, and there's no age test. So we're fine. That one is yes. How about down here, the last one? Taxpayer's grandson lives with her and has gross income 7. Grandson. Well, taxpayer's grandson lives with her. A grandson will meet the criteria here and here and has gross income 7. Well, relationship, yes, this is fine. Grandson will do it. And how about residence? Taxpayer lives with her. That's fine too. That means it could be a qualifying child. Now over here, is a grandson going to work for a relationship? Yes, it will. And the 7,000 though, what's that going to do to gross income? That violates the qualifying relative. So because it violates it, again, you're going to have a no there. This is a hard one, but it's a really good review. This tells you, again, when you can decide if somebody is your dependent. And again, a dependent can be a qualifying child, which is the best, or a qualifying relative. Let me say one more thing. There's one more I didn't have up here. I now remember what I was going to say. Under qualifying relative, they'll let anyone, including a cousin, can be a qualifying relative as long as that person lives in your house the entire year. So there is an exception. You can violate or not comply or don't meet. You will not meet the relationship test if you have a cousin. But if the cousin lives with you the whole year, see, this one said the cousin does not live with her. But if the cousin does live with you the whole year, then you can go ahead and call them a qualifying relative, regardless of relationship. Okay, this is done. That was a long one. I just noticed something a minute ago. We did these right, but I wrote the wrong things right there. Swap these out. I verbally said the right thing, but I wrote them in the wrong place. Taxpayer's older nephew is age 23 and a full-time student. A nephew will meet a relationship test. That's fine. You know, a relationship. But again, 23 and a full-time, how old is that, right? The relationship test. Taxpayer's older nephew. Oh, no, 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 no. Older nephew. Yeah, taxpayer's older nephew is age 23. Older nephew means older than the taxpayer. So again, if the taxpayer, in this case, older, you can't be a qualifying child if they're older. So this will be no. Now how about age? 23, if you're 23, that again, does that violate the 24? No. And a full-time student. So that's okay. So you do mean that test is a fine. So this is yes. Anyway, everything was fine except for that. Yeah, you can't have a older than you. If they're older than you, then again, you can't have a child. But it doesn't matter if they're older than you for a qualifying relative. Okay, this is 32. This is on the exact same topic. Exact same topic, it's just reinforcing. Determine the number of dependents in each of the following independent situations. Remember what we're looking for. Let's do it this way. We'll try and find either a qualifying child or we'll try and find a qualifying relative. All right? That's what we're trying to do. Leo and Amanda, in other words, if we find them, let's write them down. Leo and Amanda, ages 48 and 46, are husband and wife. They furnish more than 50% of their 2 children. Elton, age 18. That sounds good. He's going to make the age requirement. And Trista, age 24, she violates the age requirement, so she can't be a qualifying child. During the year, Elton earns $4,500, providing transportation for elderly persons with disabilities, and Trista receives a $5,000 scholarship. Okay, that's a lot of mumbo jumbo there. Let me see. Let's see again if we can do this. Elton, age 18, I think he's going to be a qualifying child. He meets the age requirement. What's he do? Elton earns $4,500, but that doesn't matter because, again, there is no test. Remember qualifying child? You don't have to worry about money. That's on qualifying relative, providing transportation for elderly persons. So he meets the age requirement. The other requirements they don't say anything about, so we'll assume it's okay. Now let's go. Trista can't, she's age 24. And again, so no matter what, she can't be a qualifying child, but she might be able to be. Trista could be a qualifying relative. She receives a $5,000. Oh, that goes above the money. Remember, she has to be, Trista is a child. She meets the relationship test. She has a gross income test, and you'd think that violates it, but it's a scholarship. And scholarships are not counted in gross income. So you can really just think of that as zero. Because again, scholarships are for college. Congress decided that they're not going to count that as income. And again, it is money given for merit, for scholarly merit. For tuition at a law school she attends. It doesn't matter, she still violated that. She can't be a qualifying child, but she can be a qualifying relative. The answer to this is 2. And so this is 2. All right, let's try and do this. Audrey, age 45, was divorced this year. She maintains a household in which she and her ex-husband Clint live, and his mother Olive live, and she furnishes more than 50% of their support. Olive is age 91 and blind. All right, now we're just trying to decide, are these a qualifying child or relative? Well, again, Crystal, this is Audrey, 45. So she maintains a household in which she and her ex-husband Clint live. An ex-husband cannot be a qualifying child. I never said that, but it might make sense to you. Mothers, fathers, he can't be a qualifying child. So the best Clint can be is a qualifying relative. And his mother, and she is divorced, isn't she? Divorced. She divorced Clint. And Olive lives and furnished more than 50% of their support. Olive's age 91 and blind. Clint is fine, I think. This is going to be, Clint can be a qualifying relative. And I think Olive can be a qualifying relative. Let's double check that. Now, the only time you can't take Clint as a qualifying relative is if they were divorced this year. Oh, she was divorced this year. Yeah, can't take him. After the divorce is over, next year, she can take him. But he doesn't qualify as a child. He certainly doesn't qualify as a relative now. So this one's only 1. This one's only 1. Okay. Crystal, age 45, furnishes the support of her married son, Andy, age 18, and his wife, Paige, age 19, who live with her during the year. Andy earned $8,400 from a part-time job. All parties live in Iowa, which is a common law state. You live in Illinois, and Illinois is a common law state. That means really one of the laws is that if you're married and you make $5,000 and your spouse makes $10,000, they see that income as separate. I mean, I know you're a married entity, but they see you with a 5 and your spouse with a 10. If you lived in a community property state, they make you add the 5 and the 10 together. That's 15, and then they say each of you make half, which is 7,500. That's a community property state. Anyway, but you live, so let me see here. Furnishes more than 50 for a married son, Andy, age 18. Well, age 18, he makes it. He could be a qualifying child. Let's see if he does. And his wife, Paige, who live with her, they live with her during the year. Andy earned 84, but you don't have to worry about that because he's a child. So again, he doesn't have, remember, a qualifying child doesn't have a limit on money. Only if you're a qualifying relative. That doesn't have, from part-time job, all parties live in Iowa. Okay, so he's fine. He's a qualifying child. Let's talk about his wife. His wife's 19, so she can't be a child. And she's not a college student. Paige, who lived with her during the year. And Paige, she could be a qualifying relative who lived with her during the year. Andy earned 8,400. Doesn't look like Paige earned anything, so she's fine. Remember, she's got to be the right. She's a daughter-in-law. That means she's made the relationship test. The other test is she doesn't make too much money, $4,200. She doesn't say she makes any money. And and they support her. That's the other test. So I think we've got 2 here. Qualifying child, qualifying relative. Assume the same facts except that all parties live in Washington, which is a community property state. Well, what that means is in a community property state, they take the money and they say, well, everybody's in the same community, meaning the family is a community, and we divide it and say that, again, if the boy made 42, and Annie made 42, now they say Paige has now made 42. Community property assumes that husband and wife, the property is a community, the income's a result of the marriage. So, looking at this, 42 and 42, does that change anything? Well, he's still a qualifying child, the money doesn't mean anything, but now Paige, that violates the 4,200. Remember, that's the limit? So now Paige won't qualify anymore. She can't be a qualifying relative. She's gonna be, because again, the money, she's now making 42, that violates that. So now in D, we're back to 1. And you've learned about what a community property state is. There's a lot to learn in life, isn't there? That's for sure. Okay, we're doing exactly the same thing again. Different problem, but we're going to identify the number of dependents. Remember, a lot of things in our tax code in this country are determined by if you have a child or an aunt or an uncle or a mother or father that you're supporting. Determine the number of dependents in each of the following independent situations. Identify whether the dependent is a qualifying child. Let's do that again. Qualifying child. And I don't know if I changed my colors, but this time we'll do qualifying relative. Okay, let's see if we can identify these. And he maintains a houseboat, no, I'm kidding, a household, that includes a cousin, age 12. A cousin cannot be either. Cousin cannot be a qualifying child or a qualifying relative unless the cousin lives with him all year long. If the cousin lives with him all year long, then he can qualify as he can be a qualified relative. A cousin, a niece does qualify with a niece is a qualified child, age 18, and a son, age 26. All are full-time students, and he furnishes all of their support and all are members of the household. Well, this is going to do it. The cousin he's a member of the household, so he'll make it as qualifying relative because he lives. All are members of the household. They live there all year. That's usually a cousin won't do it, but if the cousin lives there all year, they call it a member of the household. You can get him as a qualifying relative. A niece does make it. That is a qualifying child. Age 18. She does make it. That's a qualifying child, age 18. And a son, age 26. A son, age 26, cannot be a qualifying child But a son can be a qualifying relative, right? So we can go back and say that's going to be a qualifying relative. There's no age test for, again, a qualifying relative. Now, and they say as a member of the household, all our full-time students. But again, he still doesn't make the age group. So again, we have 3 here. 3. Because he does not make the qualifying child age test, but he does meet all the tests for qualifying relative. Mandeep provides all the support for a family's friend's son, age 20, who lives with her. She also furnishes most of the support for her stepmother, who does not live with her. Well, a friend's son who lives with her, that's going to work as a qualifying relative. A son is not going to meet the criteria for a relationship. In fact, a son is not related to you at all, but as long as they live with you, and there's no age test, remember the 3 tests for that? It's, again, the first test is relationship, but you don't have to worry about relationship, they live there all year. Second test is gross income. They don't give you any gross income. And the third one is support. You support them, so they're going to get qualifying relative on that. She also furnishes most of the support for stepmother. Stepmother cannot be, in-laws can't be qualifying child, so at best this can be a qualifying relative. And it does meet the criteria for relationship, and then again, does the stepmother who does not live with her. That's okay for a qualifying relative. So this will give us 2. A qualifying relative, do you remember? They have to meet do you remember the test? RGS. Relationship, yes. Gross income, yes. Support, yes. But you don't have to live. So again, that'll do it. Rahul, a U.S. citizen, lives in Costa Rica. Rahul's household includes a friend, Mariana, who is age 19. I don't know why, but that sounds a little suspicious to me. Lives in Costa Rica. Rahul's household includes a friend, Mariana, who's 19. And a citizen of Costa Rica. Paul provides all of Mariana's support. All right, well, you have to be a U.S. citizen. You have to be a U.S. citizen or resident, or you have to be a resident of Canada or Mexico for part of the year. Costa Rica is not in there. So again, this is no. This is no. This is 0. She is age 19, again, but the problem is she's a citizen of Costa Rica. If he adopted her, it would work, but he'd have to adopt her, and then he could get he could be a qualifying relative, I suppose, but she's too old, and she's not a student. Karen maintains a household that includes her ex-husband, her mother-in-law, and her brother-in-law, age 23, not a full-time student. Karen provides more than half of all the support. Karen is single and was divorced last year. Well, this is different. She was divorced last year. You can actually call your ex-husband. This actually happens. You can let your ex-husband live with you, and he can be a qualifying relative. Can't be a qualifying child. That would make sense, right? But he'll meet the relationship test. He'll meet, again, the gross income. It doesn't say he makes too much. And the support. She supports him. And they weren't divorced this year. That's the rule, that in the year of divorce, you can't do it. But if you want to let the guy come back in and live with you, then you can get a qualifying relative. Her mother-in-law, that's okay, but that's going to have to be a qualifying relative. Mother-in-law is only going to make relative. And her brother-in-law, that's again has to be qualifying relative. Do you remember no in-laws can be a child? Age 23 and not a full-time student. Well, again, there's no, for qualifying relative, a brother-in-law, age 23 and not a full-time student, that doesn't matter because that does not in the he meets the relationship test, gross income test, he doesn't violate, and support. She supports him. So this is not applicable to a qualifying relative. So these are, again, going to be 3. It's going to be qualified. I think all 3 of them are qualifying relative. All right, we're getting close to the end. Just